Welcome to The Explainer. Today, we are pulling back the curtain on the single most important rule in business. I'm talking about the one equation that makes sure everything from your local corner store to a massive global corporation is always, and I mean always, perfectly in balance.
Seriously, picture it for a second. You walk in, you see the building itself, the cash register, all those snacks lining the shelves, the big drink coolers, all of it. But how does a business actually keep track of all that stuff? Well, that's exactly what we're going to break down today. So, it all starts with our very first building block, assets. Put simply, this is all the valuable stuff a business has and controls. It's everything they can use to make money. Okay, that sounds a little academic, right? Let's translate that into plain English. An asset is basically something valuable that the business controls right now because of something that happened in the past that's expected to help it make money down the road. So how do you know for sure if something is an asset? Well, here's a super simple 3-point checklist. Let's go back to those snacks at 7-Eleven. First, are they a thing of value? Yeah. Second, can you measure that value in money? Absolutely. And third, does 7-Eleven have the rights to them? It sure does, right up until you buy one. So, it passes the test, it's an asset. Easy, right? But here's the thing, not all assets are created equal. We split them into two main groups, and it's all based on a really simple timeline, 1 year. Are they fast-moving things that can be turned into cash quickly, or are they the kind of stuff that's built to last? Current assets are all the things that are either cash already or are expected to become cash within a year. You know, cash in the bank, obviously, but also money that customers still owe you. That's called accounts receivable. And it's an asset because you're planning on collecting that cash pretty soon. Then you've got the non-current assets. These are the long-term heavy hitters of the business, the things you buy to use for more than a year to help you actually run the place, like the delivery van, the computers in the office, or even the building itself. But let's be real, a business almost never owns all its stuff outright, free and clear. And that brings us to our second building block, liabilities. In a nutshell, this is what the business owes to other people. Just think of a liability as a debt. It's a responsibility you have now because of something you did in the past. And to settle it, you're gonna have to give up something valuable, which, let's face it, is usually cash. And hey, guess what? That same 1-year rule we used for assets, it works perfectly for liabilities too. We just ask, is this a short-term debt we need to pay off soon, or is it a long-term thing we'll be chipping away at for a while? Some classic examples would be accounts payable. That's the money you owe your suppliers for all that inventory. Or a really big one, like a long-term bank loan you took out to buy that building or delivery van we were talking about earlier. Okay, so we've covered what the business owns, its assets, and what it owes, its liabilities. So what's left? Well, that is the owner's true stake in the game, and we call that owner's equity. The most important word here is residual. It's a fancy word that just means what's left over. Equity is the value that's left for the owner after every single debt is paid off. It's the piece of the assets that the owner can truly, honestly say is theirs. It honestly boils down to this incredibly simple idea. If your business has assets worth, say, $100, but you've got debts of $30, your real stake, your equity, is $70. That's the part that's truly yours. And just keep in mind, the owner isn't always just one person sitting in an office. It could be two partners who started a firm, or it could be literally thousands of shareholders in a giant public company. The structure doesn't matter. The idea of equity stays exactly the same. All right, we have our 3 building blocks: assets, liabilities, and owner's equity. Now it's time for the main event. We're going to put them all together and reveal the golden rule of accounting.
So how in the world do we connect what a business owns, what it owes, and the owner's piece of the pie into one single, perfectly balanced idea?
And there it is, the accounting equation. It's beautiful, isn't it? Think about it. Everything a business has, its assets, has to be claimed by someone. It's either claimed by outsiders like banks and suppliers, that's the liabilities, or it's claimed by the owners, that's the owner's equity. There's literally no other option. You will almost always see it written just like this: A equals L plus OE. It looks simple, maybe even a little too simple, but it is without a doubt one of the most powerful tools in all of finance. Now, this is the most crucial part. This isn't just a guideline or a suggestion, it's a law. For every single transaction, for every business on the planet, this equation has to hold true. The two sides must always be equal. Always. No exceptions.
All right, theory's great, but let's get our hands dirty and see how this actually works with a really quick example.
So imagine a small business has 10,000 in assets. That's their cash, equipment, the whole shebang. We also know it owes 2,000 in liabilities, maybe a small loan. So we just plug those numbers right into our formula. And to find the owner's equity, we just do a little bit of simple algebra to rearrange the equation. And boom, there's our answer, 8,000. That is the owner's true stake in the company. And now, look at that. The equation balances perfectly. 10,000 in assets on one side equals 2,000 in liabilities plus that 8,000 in owner's equity on the other. Every single dollar is accounted for. So the next time you're in a store or you see a big company's logo, remember this invisible scale. Everything they own on one side is perfectly, and I mean perfectly, matched by who has a claim to it on the other. This isn't just some boring accounting rule. It's the fundamental blueprint of the entire business world. Now you can see it everywhere.